Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position along with your favorite beverage to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from the audience of SmithWeekly, including Michael G., Jerry S., Sean M., Jack T., and Craig S. On the program today is a returning guest. Mr. Amir Adnani has joined us. Amir is the president and CEO of Uranium Energy Corp, a North American-focused uranium restart and development company with projects spanning an ISR portfolio in Texas and Wyoming, among several conventional U.S. projects, as well as conventional projects in Canada's Athabasca Basin. Uranium Energy Corp is listed on the New York Stock Exchange under the symbol UEC. Amir, welcome back to the program.
Hey, thanks for having me. I've got my favorite beverage. I'm ready to go.
Excellent, Amir. It's been a while since you've been on the program. Why don't we just kick things off here with just you giving us your view of the current status of the uranium market here, and more specifically to the point on things you're seeing on supply chain issues, fuel cycle, and also the supply response so far.
The supply response is a big part of this whole conversation. So if we start really kind of at a high level, I mean, this is a situation in the uranium market today that is almost 12 years in the making. We had a 12-year bear market where during those 12 years, there wasn't anything done to develop and grow the supply side of uranium. The demand side of uranium, which is nuclear reactors, did just fine over the last decade. Over 65 reactors, to be exact, 69 reactors were connected to the grid over the last decade. So the industry on the nuclear side and on the demand side didn't lose the art and science of building new reactors. And as we speak, there are another 60 reactors or so under construction and hundreds more planned. The industry on the supply side, though, did lose the art and science of building uranium mines because no single significant new uranium mine was built over the last decade. Projects and production were, in fact, curtailed and cut back. People were laid off. We have a whole set of other energy transition industries out there that today compete for the same geologists and engineers. People have to remember that in previous bull market cycles for uranium, let's say back in 2007, there wasn't really a lithium industry. Today, there's a lithium industry with pretty decent lithium prices, and those are competing with the uranium industry for geologists and engineers that are already a scarce commodity, but becoming even tougher. Supply chain bottlenecks are real post-COVID, and even the biggest players in North America, you look at Cameco, have announced recently issues with keeping their production levels up because of human resource issues, labor issues, supply chain issues. So there are real challenges, I think, on the supply side to react and respond to this deficit, this growing deficit that we see between demand for uranium approaching 200 million pounds per year, and then supply of uranium around 145 million pounds. These are the 2023 forecasts for supply demand. And that gap really requires not just one or two, but probably 6 or 7 new uranium mines to come online. As we speak, there are no significant new uranium mines under construction anywhere in the world. Companies like ours are talking about production restarts. So those are mines that were put on care and maintenance over the last number of years. And that's not going to be enough. Production restarts aren't going to basically solve the deficit problem that we see on the supply side. The other issue that we see is if you look at a bifurcated world as a result of geopolitical lines, you realize that there's even a bigger deficit for Western utilities. Western utilities from US, France, and even if we include Japanese restarts in there, and Japanese reactors, South Koreans, etc., they are most vulnerable to the issues that we're seeing emerge as a result of either potential sanctions on Russia or transportation insurance issues that lead to logistical problems for moving uranium out of Port of St. Petersburg. And that's almost 40% of enriched uranium product comes out of Russia. Russia's about 40% of enrichment capacity. And even though Kazakhstan, the world's biggest uranium producer, is a separate country, almost half of its production is owned under joint ventures by Rosatom, Russia's nuclear energy company, and it sits on the border of China and Russia. So it's easier to move uranium from Kazakhstan into China and Russia than it is to Western markets. So Western markets, I think, are even at a bigger risk of supply side reliability. And this is, I think, the issue that now is starting to manifest itself in the uranium price. If you and I look at the uranium price on a daily basis, there's a differential, there's a bid and a premium for material if you can deliver to Metropolis, Illinois on US soil at ConverDyn versus even Cameco or Comirex in Europe. So there is a bifurcated market developing. This is not abnormal. You see this in other commodities. You see it in oil with the price differential between Brent and WTI, or oil that you might be able to buy from sanctioned countries will typically carry a discount, so on and so forth. So this is a setup like we've never seen before in the uranium business, where you have a confluence of factors impacting both the availability of supply to all market participants because of geopolitical issues. But this is the first time the uranium industry is having to respond to supply side needs for growth while we have high interest rate environment, while we have supply chain bottlenecks, while we have an all-time high competition for skilled labor when it comes to jobs related to mining. And so I expect that we're going to see, as we've already started to see here, elevated uranium prices. But I think we're going to see elevated uranium prices for much longer because the supply side response will need more time as it develops and becomes available.
Thank you, Amir, for that. Brings up a lot of issues. I want to come back to a few of those as we get further into the discussion, specifically more towards Uranium Energy Corp. It's a tough market out there. It's pretty beat up. Not a lot of people like to produce or can produce. That's also a challenge. And I struggle to pencil in where some of this material comes from to fill out the demand. Good setup we have in some ways, and then also just a poor state of affairs on the other side as well. So why don't we get into Uranium Energy Corp just at the high level for a moment on capital structure, and then let's get into a bunch of details. But on capital structure here, can you just cover off for us the cash on hand for the company, shares outstanding, and also the major shareholders in the company at this time?
So Uranium Energy Corp today is a approximately 18-year-old business. In these 18 years as a U.S. company, that's U.S. listed only, we've seen and done it all in the uranium business. We went basically from a business plan in 2005 to initial production using in-situ recovery in South Texas in 2010. We got unlucky there because Fukushima happened in 2011. And after a couple of years of production, we put our production on care and maintenance and basically pursued a decade of bear market acquisitions. And we thought that was the best way to take advantage of the bear market. But during UEC's 18-year history, this company has produced uranium. We've permitted uranium projects. We have sold uranium. We've restored projects. We've made discoveries. And we've made many, many acquisitions, which I'll talk about. So today, as of our latest financial filings, the company had on hand approximately $192 million of cash, physical uranium inventory, and our uranium equity holdings, including names like Uranium Royalty that you're familiar with, Andrew. Most importantly, UEC carries no debt. This is a debt-free company, so 100% unlevered, and of course also 100% unhedged. Our future production is unencumbered and hasn't been contracted or committed to anyone. We have approximately 378 million shares outstanding, and the company has a share price of around $5.30. Top shareholders include the management team, including myself as the founding CEO of the company, along with a number of resource and uranium-focused funds like Segra Capital, and MMCap out of Toronto, Sachem Cove, and some of the larger U.S. institutional investors such as BlackRock and some of the Canadian names like Sprott Asset Management. The company is fairly widely held. It trades on the NYSE American, and it's the second most liquid uranium stock after Cameco. Our 1-year average daily volume is about $32 million a day, but in recent month or two, with increased interest in the sector as a result of increased uranium prices, you see UEC averaging closer to about $40 to $50 million a day.
Good cash position here obviously provides quite a bit of optionality on a number of various plans and initiatives over there at the company. Why don't we move into the US-based operations ISR focus and just talk about, if you will, for us, some of those initial production restart plans, both, of course, at Texas and at Wyoming operations, specifically, the price conditions that you would like to see in the market to facilitate formal restart of those operations and some of the capital expenditures related to those restart operations, and then the duration you see to commercial restart at both locations. Also, if you see the need to raise capital in order to put these operations back online, obviously with the war chest you do have, that may not be needed, but just talk about those points for us.
As I mentioned, UEC is a 100% unhedged company, so we have not signed any contracts with ceilings or fixed pricing, and we believe this is a good strategy in a market environment where there's a deficit. We talked about that deficit. We think there's going to be time needed for the supply side to grow. So as a result, again, our thesis is higher uranium prices for longer, and as a result, we like to have that flexibility to sell uranium into the spot market and take advantage of spot market pricing. Now, just because we sell in the spot market doesn't mean we may not have contracts. We could have contracts, and you may see us have contracts, but those contracts basically don't have pricing that is fixed or capped. Pricing is what we see in the market. We want market-related pricing for our company and shareholders. As a result, we want to see the spot market for uranium above $60 a pound. Obviously, it's there right now. We want to see it there for a couple of more months. So that takes you to the end of the calendar year before we make a production restart decision. So we are on track right now, whereby we could very well be in an exciting position come January to announce production restart, because by then we would have had the benefit of 3 to 4 months of these elevated uranium prices. Of course, our threshold always was $60 per pound. Obviously, right now, the price is over $70 per pound. That's obviously very good. We're very happy with that, and suspect it'll probably stay around these levels come January. From there, the production restart that we're planning focuses on our U.S. assets that are all basically in situ recovery projects in Wyoming and Texas. We do have some hard rock assets in Arizona, but that's not the focus for production restart. In Wyoming, and to kind of really inform the listeners about what gives UEC the advantage and the ability to be in a production restart, it really is twofold. Number one, as I mentioned, we're an 18-year-old business. We have the technical and operating know-how to build and produce uranium using in situ recovery. We've actually done it. We're one of the few companies out there today that can say, as a management team, as a company, we have produced uranium in the last 10, 15 years. And so our technical know-how, our operating experience definitely is an edge, but so are the acquisitions that we made. We made an acquisition when uranium was at $35 per pound before Russia's invasion of Ukraine, of a business called Uranium One. Uranium One Americas was wholly owned subsidiary of the Russian government, 100% owned by Rosatom, Russia's nuclear energy company. And this is a business that the Russians had assembled on U.S. soil, really putting together the best and biggest projects in Wyoming in this company over a decade-long consolidation effort by the Russians. It was always a bit curious to everyone how the Russian government was allowed to own these assets on U.S. soil, but they did. And about a year before their invasion of Ukraine, they ran a global process to sell these assets, including a fully licensed processing plant, 4 fully permitted mines, 1 mine that was in production until 2018, You would, if you look at this had cost the Russians to accumulate, it would have been close to $2 billion over 10 to 12 years. At uranium prices of $35 per pound, we paid $112 million cash to acquire this business. And at the time, I have to say, it was a big bid. It still is a big bid. That's a lot of money. But it put us in a position where we acquired assets that today have incredible scarcity. It takes a long time to permit. Of course, there's a major re-rating on acquiring assets at $35 uranium when uranium is now at $74 per pound. And this acquisition of Uranium One certainly transformed UEC into America's leading uranium mining company, particularly with the ISR focus, which is what we believe is the way forward. And so when you look at that acquisition, and of course, again, this acquisition was closed before Russia's invasion of Ukraine. So of course, in hindsight, it also became a bit more clear to us as to why the Russians were selling. But that certainly today is where production restart for UEC can be accelerated. The Christensen Ranch mine was in production until 2018. The Irigaray processing plant was processing uranium up until recently. We had a toll processing customer. So the plant is in great shape. The mine is in great shape. Up until recently, we've also completed refurbishment and upgrade work at these facilities. We have 3 additional fully permitted projects in Wyoming. This is all in the Powder River Basin of Wyoming. For the benefit of your listeners, in situ recovery of uranium is responsible for 45% of global production. Kazakhstan as a country leads the way. Outside of Kazakhstan, especially in the Western Hemisphere, more uranium has been mined using the in situ recovery method in Wyoming than any other jurisdiction. Wyoming has a 40-year history of this method of mining. Over 250 million pounds of uranium has been produced here. So this is a state that understands uranium mining, has the right geology, has the right regulatory framework. We have fully permitted projects, and the geology is amenable to the low-cost in situ recovery method. So UEC, again, is in that very unique position where we're not out there raising capex financing to build the mine. The processing plant that we're restarting production with next year are built and ready to go. And that's a major advantage because, again, we not only save that capex, but we shield our investors from not being exposed to today's high interest rate environment. We're building any infrastructure, be it a mine or a mill or a processing plant, is going to be exposure to interest rates, engineering risk, construction risk, and potential delays. We don't have those risk factors here. So I think we're in a very good position. We will start with Wyoming first, and that will be around the mid-2024 event in terms of when initial production can restart. And about a year after that, we will look to restart the Texas operation. This is all obviously given our team and company ability to ramp up. We have to hire, we have to get people in place. And so you might be wondering, well, why don't you just start it all at the same time? And there's a bit of a staging to make sure that we are adequately staffing and growing this production for years to come.
On the ISR projects here, operations in the U.S., talk about where you see that all-in sustaining cost per pound coming in. Obviously, it's going to be different between South Texas and Wyoming, of course, but just talk about what you would expect for all-in sustaining cost per pound coming in once you guys get to steady state commercial production. Give the audience a little bit of a flavor on the leverage. $80, $90 uranium is certainly going to come. Maybe just talk about what you think that cash flow looks like.
ISR projects, again, have a benefit of low capital intensity. The upfront capital requirements are typically just, once you've built a processing plant, you're talking about drilling vertical water wells, down 300-400 feet from surface. And so you're drilling and casing most of the time. That's most of your development capital. We suspect, and this should be really no surprise, but when you look at US ISR projects in Wyoming in particular, you look at other companies in the sector as well, in the Powder River Basin, in the Great Divide Basin, historically, all-in cost has come in around $30 to $35 per pound. We suspect in 2023, going into 2024, those numbers are probably going to be closer to $40 per pound. in terms of an all-in cost of production. Again, this is adjusting for some inflation. This is adjusting for just a higher cost environment that we live in today. So you can see from that kind of base what the leverage is to uranium price. That's a decent margin at $60, which is the restart threshold that we had in mind. But it starts to look very attractive at 70. And of course, anything above that, just these projects, I think, start to look like very healthy operations. Again, for the benefit of listeners, or if you're new to uranium, for most of the last decade, uranium prices were not just less than $40 per pound, they were less than 30, and for even a period, less than $20 per pound. So that's the reason why these projects were put on care and maintenance, were below their marginal cost of production, but we just have a very different environment today. UEC's licensed capacity is roughly 8 million pounds across Wyoming and Texas. That's our annual license capacity. Total in situ recovery amenable resources that are SK 1300 compliant is around 100 million pounds in all categories of measured, indicated, and inferred. About 75 million would be measured and indicated, and 25 million or so would be inferred. So this is the largest resource base in the country of any company that's in situ recovery amenable, and a majority of that is fully permitted as well, all in Texas and Wyoming. Andrew, I don't think initially the target is to get to obviously that full license capacity, but over a 4 to 5 year time frame, we would look to ramp up the production. And even if we're able to get to 70 or 80% of our current license capacity, that would certainly make this not only the largest U.S. uranium company, but definitely a top 5, top 6 globally. And also just the fact that the production has very high margin and no significant capex requirements, since most of it is already built. This would be, in my opinion, one of the strongest projects out there anywhere in the world in terms of financial returns, but also the timeline to production being basically within the next 12 months.
Good points on the license capacities and the time frame we're looking at here. And as you know, the U.S. is various facilities, conventional ISR, what have you, is always generally never gotten to those license capacity numbers. Not saying it's not impossible, but definitely it's been a challenge in previous periods and obviously past cycles.
Let me comment on that, because you raise a fair point. But at the same time, to be fair to the industry, the uranium price in the last 20 years has really not had a sustained period of strong prices where U.S. companies can really grow into. Like, we must remember that over the last 20 years, we had the 06-07 bull run, which lasted all of 12 months. And we had the 2010 rally that was starting to take place and was cut short because of Fukushima. So in regular commodity cycles, you might have 3 good years and 4 bad years. And in uranium in the last 20 years, we've had 17, 18 bad years and 2 and 3 good years. And mining just takes longer than that. And the U.S. industry in the last 20 years has not had sufficient runway with stronger prices for more sustainable periods to be able to really ramp up production. And if we go back to the 60s and 70s, where there were sustained prices for longer, the U.S. industry did get up to producing about 40 million pounds per year collectively. And it is capable of doing that. We just need the right price environment for uranium, which collectively in the last 20 years we haven't had.
And obviously, if we keep that pricing for a long period of time, you'd finally attract the skills and people, et cetera, to finally get to that level. As you said, it's going to take a number of years to get there. You have to obviously attract talent to the industry as well. And typically they don't show up overnight, as you know. It's going to be very interesting here to see how things go on the production front. And the U.S. Pretty much wasn't even on the scale last year as far as production goes globally. It'll be interesting to see what kind of response happens as we turn over in the cycle here. And of course, policies change and the bifurcated market and all the various other parts that have played in here. With that, just on the capacity side and, excess capacities, Amir, obviously you guys are looking to fill that excess capacity as you ramp up in the 4 to 5 years ahead once steady state commercial production happens. Talk about that excess capacity, and also let me just couple it with under the prior ownership there, which was Uranium One, had a toll processing agreement with Peninsula Energy that was done, of course, under Uranium One for the facilities there in Wyoming. But just talk about, excess capacities. Will you guys look to toll process in the future? And of course, that decision to not do toll processing at this time.
There's certainly excess capacity. Both Hobson and Irigaray are fairly large operations and plants. Hobson has a 4 million pound license capacity. Irigaray is at 2.5 million right now, but we're in the process of increasing that to 4 million as well. At Reno Creek and Moore Ranch, we have 2 additional locations where we are actually permitted for having a central processing plant. So this is a company that today, the first phase of my life at UEC when we were getting going was all about permitting. It takes 7 to 10 years to permit these sites. Today, we're really lucky because, again, we have the 2 permitted facilities at Hobson and Irigaray, but 7 satellite projects that are fully permitted as well for development and production. So we're lucky where we're not sitting here talking about permitting, de-risking, and really, I think that's an important issue. So with spare capacity in the long run for any company, and this is more so true for ISR, I think in conventional mining, mills like the feed they can get from third parties because mills are very expensive operations. Conventional mining and milling is just a different kettle of fish than what we're talking about. And with ISR processing, there just isn't the same kind of attractive business case for having third-party processing. I think for sure, if we see a strategic objective around doing a third-party toll processing using spare capacity, we would consider it. But as you pointed out, I think the example of the one contract that was there that predates UEC, and as you pointed out, it was there from the Uranium One days. There was no business case there, and frankly, UEC needs to be focused on our own production restart, which is why we decided to terminate that one contract. And these contracts on toll processing, frankly, are mutually possible to terminate. So it's not just our right to terminate; the other party can terminate as well with the exact same notice and right. So it's a two-way street, and I think any company that wants to plan production in a sustainable fashion needs to be able to support its own processing infrastructure. That's what makes a good business. But our realization, and by now we've talked about this many times, our realization again is the fact that with scarcity of talent and labor, that talent and labor at a time of fundamental kind of shifts that you're taking as a company, i.e. going into production, needs to have 100% focus factor, right? And so when there's really a shortage of people, you really think about how to make sure their time is invested on behalf of the company in a way that most benefits the company. We see that for UEC today being all about production and production restart of our own assets from our own mines and our own projects, and anything else is just distraction that we can't afford to have.
Yeah, appreciate your comments there, Amir. It's always a challenge, whether it's the timing of operations, whether or not you want to be in operation at this time versus, as you said, in 2024, deposit types, chemistry. There's a lot of different things. Obviously, these things are set up for certain deposits. Interesting on that piece of it too. So there's always lots of other pieces that kind of play into this, and it's just not as simple as it looks, or a light switch flip, if you will, on some of these things. There's a lot of work that goes into processing material. Just to discuss some of the acquisitions that we didn't cover, let's move outside the U.S. for a moment and talk about maybe some new large project developments that you guys would have in the pipeline potentially here. What you see as the first project that would be advanced on the conventional front. Let's focus in on Canada, perhaps. What do you think the time frame would be? What do you think that first project would be? And just overall plan on new builds?
The trend that, again, we've been paying a lot of attention to is this trend of Western utilities looking to diversify away from Russia. This, again, is a trend that I think has gained a lot of momentum since the invasion, and as the issue with the war has just continued to go on. And so really kind of looking at our historic kind of presence in the U.S., where as a business we've been there for the last 18 years, we felt it was a good time in the last couple of years with uranium prices still still in the early stages of their recovery, we felt there were attractive acquisition opportunities to also enter Canada's Athabasca Basin. And the Athabasca Basin, for the benefit of the listeners, is a more of a high grade conventional area where historically the production has all been utilizing conventional mining methods, underground mining methods. It's an area where in conventional mining, the old saying is grade is king. And the grades here are about 100 times higher than the average grade of uranium anywhere else in the world. So this is kind of an unusually high grade area, good long-standing history of uranium mining, and the world's kind of number one, number two largest uranium mines, Cigar Lake, McArthur River, are in this part of the world. So we felt it was strategic and certainly important if UEC is to really position itself as a top name, as a go-to name in North America with reliable North American supplier, to be able to have both US and Canadian assets. And the way we've kind of constructed the portfolio is to say, we believe US ISR projects are going to be faster to take into production. They're permitted, they're lower cost, lower capex. And so we have exactly that in Wyoming and Texas. But we're now building this pipeline of resources in Canada that have multiple kind of avenues of growth in front of them, which I'll talk about, that gives the company significantly more leverage to higher uranium prices and future production from the Canadian side. The Canadian side came together for us through two acquisitions. We acquired a publicly listed company called UEX, and we acquired an asset, a single asset from Rio Tinto called Rough Rider. UEX was a publicly listed company that had been around for 20 years. It was originally created as a joint venture between Cameco and Pioneer. The land and the projects that they had been able to get their hands on over a 20-year period was quite exceptional. Athabasca Basin today is a very coveted location to be in. It's like getting your hand on real estate on Fifth Avenue. Every block is taken. And so if you could pick up land 10 years ago, 5 years ago, 20 years ago, it would surely be more attractive locations than what's available today. So we saw a very attractive target there in UEX. They had multiple projects, multiple joint ventures, bits and pieces of stuff they owned 100%. So we acquired UEX, and that was a very timely acquisition. That was again a uranium price around $40 per pound, and with uranium prices around $45 per pound, when Rio Tinto was looking to exit the uranium business globally, we were able to acquire Rough Rider, which is a project that Rio had got into a bidding war over with Cameco in 2012, paid $640 million on it, taking it to mine development, another $140 million on mine development, and ultimately decided for a company the size of Rio Tinto, which is almost a $100 billion company, that the uranium industry was just not big enough for them. And so they were getting out of uranium. They might change their mind with uranium prices at $100 or $150 a pound, but at $45 uranium prices and lower, they were exiting. We paid $146 million and acquired Rough Rider, so that's one that we own 100%. So that project in particular, Andrew, gives us a pathway to production that could be 5 to 6 years out, but 5 to 6 years for us is great because the next 5 or 6 years we're busy growing our ISR production in the US. So it's wonderful to have a project just in one asset in Rough Rider that in 5 or 6 years from now can come in and can add to that US production. It's on the east side of Athabasca Basin, near infrastructure, near an airport, near hydroelectric power, very close by to where Cigar Lake, McArthur River are. And it's a high-grade resource. It's approximately almost 70 million pounds of resources at grades ranging from 3.5 to 4.55% grade. I mean, these are just unusually high grades. Conventional mining in the US, by comparison, the grades in the Colorado Plateau where conventional mines are typically between 0.25 to 0.35%. That's the grades of conventional mines, let's just say in the US. In Namibia, conventional open pit mines are typically around 0.03%. So you're comparing 0.03 and 0.3 to 3% or 4%. So incredible grades, and grade is really king, as I mentioned, for conventional mining. And so that's our really lead project that we own 100% that we're advancing. We're actually starting drilling on that project very soon. Very excited about some of the drill targets that we have on the project. We think it can grow the resource, define the resource better, and then we can establish an economic study around it and just advance the project through the various steps of de-risking. In addition to that, we have 5 joint ventures in Canada and Athabasca Basin with the Cameco, French government's Orano, and another uranium company called Denison. So we have 5 active joint ventures now where at $30, $40 uranium, these joint ventures were frankly idled because companies didn't have the financial interest to develop them. At $70, $75 uranium, these are projects that become interesting, especially for Orano that was getting a lot of its production from the country of Niger in Africa. Uranium exports out of that country have been halted. There's uncertainty around it because of the political situation there and basically a military coup. And that means the likes of the French government will probably increase their spending in jurisdictions like Canada. We have 2 joint ventures with Orano on large deposits. We have a joint venture with Cameco on their Millennium project. That's a feasibility stage project. And again, these were part of our UEX acquisition. So today, after Cameco and Orano, UEC controls the 3rd largest diversified portfolio in Canada's Athabasca Basin. In all categories of resources, we have close to 200 million pounds of uranium here, 5 joint ventures, over 1.1 million acres of land. And again, I can't emphasize how difficult it is to buy quality land here. All the key concessions, projects, land has got a name on it now. So to be in a span of 24 months, while uranium was still at $40 or $45 per pound, we came in fast and aggressive, and basically within 2 years have established ourselves as a top 3 player in this uranium district, which is very strategic for global production. So between US and Canadian assets, UEC today controls over 320 million pounds of uranium. That's a highly diversified portfolio. After Cameco, for North American resources, this is the largest North American resource portfolio. Again, it's highly diversified. Some of the other Canadian peers out there that have larger deposits are single asset companies, or you have US peers that are in the US only. So we feel we've created a very differentiated profile by saying, look, we've got US ISR and we've got Canadian conventional projects. We believe these are 2 of the best in class types of assets for uranium globally, but it just happens to be in North America, which we really like for geopolitical reasons. And to have all of that and still be debt-free and completely unhedged, I just think it's I think it's the right setup for this bull market that we're entering here for uranium. As you know, and I'm sure you agree, this is just the beginning of probably what we're going to see in the coming cycle.
There's a lot of things you can do in the basin for sure. It's quite crowded, as you know, mostly with just smaller juniors, Amir. There's not very many large companies up there, as you know. Lots of things you guys can do on project development, exploration work, JVs, divestments. There's lots of optionality you have up there. Just really quickly with Rough Rider, and then let's move on for the sake of time here. But with Rough Rider, a couple things. What do you see as a potential financing mix for Rough Rider 5-6 years down the road, as you said, and of course you'll be in cash flow at that point on ISR operations. Talk about financing mix, how you think that happens, and then with Rough Rider, because of its size, do you see that Rough Rider would be something that UEC would look to get into term contracting to underpin that type of production profile? Just talk about those 2 things.
Let me kind of be short and sweet on it because it's just early days for Rough Rider. You know, we've owned the asset for less than a year. We're really excited about getting on the project and starting a drilling campaign, as I mentioned. Once all that wraps up, we will put out an economic study. We're not here today to say that this project's going into production in the next couple of years. As you've heard me say, we're talking about 5 or 6 years out. So I think we have a very conservative timeline, all of which means give us some time to try to kind of come up with the best answers to those questions. You know, UEC, by the time it's time to build Rough Rider, will be cash flowing, in our opinion, significantly from US assets. We will have the financial wherewithal to tackle Rough Rider in more than one way. A lot of Canadian companies, Andrew, as you know, have no income statement, no free cash flow, and are talking about building multi-billion-dollar projects from a standing start. And so we're coming at it very differently. We're going to be producing uranium in the U.S. We're going to be generating cash flow, and then we're going to look to develop a Canadian project. What that means is that we're going to have financial flexibility and more options and ways of funding the capex. As it pertains to hedging, it's not so much that we want to hedge because a project may have a higher capital requirement. We would want to hedge once we felt the market was transitioning from being a supply deficit market to a market that was maybe reaching equilibrium. And we would make a decision around contracting really on that basis, on the basis of where we think the market is for uranium. If we see there's competition coming from other suppliers, or if the market is starting to, again, reach a level of equilibrium, then you can shift your hedging versus unhedged strategy. But if the market continues to be in the kind of deficit that it's in right now, about 55 million pounds a year deficit between supply and demand, and that's widening, the whole unhedged strategy makes sense regardless of whether you're building Rough Rider or not. And lastly, I would say, again, the other thing that really differentiates UEC to our peers, we've already, as you've seen, have established record sales and profits from the sale of our inventory program. When uranium prices were lower, we weren't just buying assets with pounds in the ground. We were buying pounds in a drum barrel. And we acquired close to 6 million pounds of uranium under long-term contract. This past fiscal year that we had for the period ending July 31st, we sold over $160 million worth of uranium, over 3 million pounds of uranium that was sold. We generated close to 50 million in gross profits. The previous year, we had sold 500,000 pounds of uranium. We still carry over 2 million pounds of inventory on hand. So this is a company that's already made some significant transitional points where we're not just talking about exploring for uranium and permitting uranium projects and maybe bringing production online. We already have an income statement. We're already generating significant sales, generating gross profits, and those numbers will grow as we bring production online, but also our available inventory is a really easy way of generating additional revenues if we continue to see these elevated uranium prices. We haven't really talked about our inventory program, but I think it's been a really effective way of us being able to lock in profits even before we see production restart at our operations.
Appreciate you commenting on those things. I was going to talk about other stuff outside of US and Canada, like Paraguay, for example, projects there, but let's skip over that. I want to wrap up with just a few other questions on a couple different topics here. Earlier this year, you had a short seller put out a negative report on the company that made a number of claims about the company projects, G&A, et cetera. As you and I both know, it's quite tough to short natural resource juniors that are specifically in a bull market environment, unless it's a very quick trade. Just any comments, just basically on that short attack?
Yeah, very short and sweet. I mean, I think at the time that the backdrop of that timing was the failure of regional U.S. banks, and it was the March timeframe, if I remember correctly. You had banks like Silicon Valley Bank and other kind of concerns that were in the market. So to some extent, I think those guys got lucky with their timing, where there was general weakness in the market, made a number of really ridiculous points that were not rooted at all in any kind of geologic models or technical models or financial models, and basically said they thought the share price was going to go lower. That's the call they made. And as you know, myself and our executive VP and the chairman of our company, who's a former U.S. Energy Secretary, Spencer Abraham, all disagreed, put our money where our mouth is. We bought a significant amount of stock in the open market. 6 months later, we found out who was right and who was wrong. UEC's trading at almost double the share price where the short attack was launched, and claimed that they thought the shares were going to go lower. So short and simple, I think numbers and results and performance basically speak for themselves.
Yep. Yeah, it worked for a couple days anyway.
It worked for a couple of days for sure. And I think that's what they were looking for, was a quick gain, a quick kind of, drive by.
Absolutely. Okay, Amir, as you know, this uranium business, like many other segments of the extractive industries, have a growing shortage of technical talent, engineers, chemists, geologists. there just isn't much wisdom transfer, and these issues go right down to really high school level curriculum, which is pretty much non-existent in most institutions. Now, of course, we have no shortage of junior promoters out there, as you well know, but just talk about some of the UEC efforts on this front. Let's couple this with community relations, government education, worker skills, call it CSR, ESG, whatever. But just go ahead on that and just talk about what you guys are doing to help reinvigorate the shortage of technical talent.
It's really working with local colleges and universities. We've done this in Texas and Wyoming and in Saskatoon, where you basically need to be part of that supply chain, for lack of a better term. We've been providing math and science focused scholarships at the high school level for many years now, especially in Texas. Our program has been ongoing for almost a decade, making sure that you recruit individuals again then from the universities and those programs down in Texas. We've done a lot with Texas A&M, for example, and now are starting to build those types of relationships in Wyoming as well. But we have a number of folks on the team that we've hired straight recently out of university over the last year, or we have individuals as well that I'm so proud to say that 10 years ago we hired at a university, and 10 years later they're still with us, and they've learned the business with us as we've again permitted projects, built projects, mined uranium, made acquisitions. This is how you basically build that human resource capital that the industry badly needs. I think Department of Energy has these surveys that shows stats around how many people work in the domestic uranium industry, and in the 70s there was close to 40,000 people employed in the domestic uranium industry, and the latest survey today shows there's a few hundred people left that are directly employed in the domestic uranium industry. So there's definitely, that's a pinch point, but it's definitely an exciting place, and it's going to have a lot of growth in it for sure. But it's one of the realities that we need to accept, that again, these mines aren't just going to be flick of a switch exercise where they just get built according to some spreadsheet financial model and they just magically come into production. The industry really ignored the need for human resources and investing in human resources because of low uranium prices for over a decade. And prior to that, there was already a generational problem even prior to that, where again, we just haven't had sustained bull market rallies in uranium really since the Cold War had ended. So this is a problem, but it's also, I think, what supports the thesis that prices will stay higher for longer because it will take time to really build that side of the industry in terms of people, personnel, and human capital.
All your efforts and more on this issue is definitely appreciated by everybody, I'm sure. Amir, you have a few other posts with some other companies in the natural resource sector besides Uranium Energy and Uranium Royalty, but also Gold Mining Inc., Gold Royalty, and also Carbon Royalty. Just talk briefly about these other companies if you want to, and then of course, how you split your time.
Yeah, just to be very clear, the only company that I've been the CEO of with day-to-day responsibilities for the last almost 20 years since I founded it privately is Uranium Energy Corp. So that's the high-level comment. But as an entrepreneur, I've, as you pointed out, been involved in the uranium sector and the gold sector. And in uranium, very proud of the work we've done to build Uranium Royalty Corp as the first and only publicly listed royalty company in the uranium sector. And in the gold business, I've been extremely fortunate to have been an entrepreneur to build a business in the gold sector called gold mining, but then to be able to attract individuals to run that company that were formerly at Gold Corp. So you look at individuals like Alistair Still, who's the CEO there, and David Garofalo, who was the CEO and chairman of Gold Corp. Alistair was the head of corporate development at both Gold Corp and Newmont. Prior to the acquisition of Gold Corp by Newmont. These are incredible individuals in the gold sector, similar to Scott Melby, who's been working with me for close to a decade now at Uranium Energy and Uranium Royalty, who's been in the uranium industry for 40 years. The key thing you learn as an entrepreneur is that business is a team sport, and your ability to attract top-notch talent to share the vision and the commitment that's needed to build this business is just as crucial as how much capital you have and how good your projects are. And my time and focus and responsibility is on UEC, and that's again where it's the only company that I wear the CEO hat on. But I've been very fortunate and lucky to be able to attract CEOs and individuals to run the day-to-days of these other businesses that I was excited enough to create. And we're obviously disappointed with the way gold equities have behaved this year, despite pretty decent gold prices. But that's also par for course in our commodity business, where I look back and I think maybe the first time I interviewed with you, UEC was trading at $1 a share, and you might think that was a long time ago. I think that was like 3 years ago, and here we are trading at $5 a share. So our commodity business, as you know, can sentiment and attitudes and pricing can change fast. But as long as companies are well structured, good balance sheets, good capital structures, and most importantly, no debt, and all my companies, Andrew, are debt free. You can really make sure you protect the downside for shareholders, and on the upside have a lot of torque and exposure, and that's what I think is playing out here in uranium as well, basically.
Well, Amir, I think we covered most things. Let's wrap up. So, for potential investors who are listening in, the company has a market capitalization of about 2.1 billion US dollars. Why should Uranium Energy be considered within the institutional, family office, and retail investors' portfolio?
Highly differentiated. This is the only uranium company that over the last few years took maximum advantage of low uranium prices. We did close to $600 million of acquisitions when uranium prices were $30 to $45 per pound. We are North American focused. We're the only company that combines US ISR near-term production with fully permitted and ready to go production with high-grade Canadian pipeline for medium to longer term exposure. Debt-free, 100% unhedged, very strong balance sheet with $192 million of cash and liquidity, second most liquid uranium stock after Cameco. US assets, US production at a time where not only US utilities, but US government is looking for enlarging the strategic uranium reserve. We are quite proud to say that we were awarded a contract to sell uranium to the Department of Energy earlier this year. We believe Department of Energy buying will increase. We believe SMRs that are going to be built in this country by the likes of Bill Gates and Elon Musk and Sam Altman will be a whole new source of demand growth for nuclear power in the US that will need additional uranium. But already, even if we discount the US government and we discount Silicon Valley that wants to get behind the next generation of reactors in this country, US consumes close to 50 million pounds of uranium, and there's less than 1 million pounds of domestic uranium mining right now. So this is a very compelling setup. It's a very compelling time to be in our position to talk about bringing US production online going into 2024. I think that's an inflection point and certainly a catalyst for the company to go through that transition. We've got the people, we've got the balance sheet, and we've got the assets to do it. And it's really kind of the rarity of everything that we're talking about to have such a large resource space of 328 million pounds, 100 million in the US, over 200 million in Canada. No other company has that. So it makes UEC very unique. Those are all good reasons, I think, to consider us. Management has big skin in the game. I've been at it for 18 years, never sold a share, and added to my position, as I mentioned earlier this year, along with other members of my senior management team. So management is very well aligned, big skin in the game, and I think demonstrated that we took advantage of the bear market. We were very entrepreneurial, very enterprising, made those acquisitions when it mattered, build a platform. As you know, Andrew, the best way to grow is to really buy at the bottom of the cycle. Majors typically do the opposite. They buy at the top of the cycle. But it's also fascinating because the only producer out there, Cameco, with a North American listing, trades at a major premium to NAV or net asset value. We trade still at a discount to NAV. So just the re-rating of going from developer to producer, I think, is also very positive and can come with a re-rating. So those are maybe a long list of reasons, but good reasons nonetheless for your audience and potential investors to consider. Go to uraniumenergy.com to find out and get more information. And feel free to contact our investor relations line. We're covered by 7 analysts. All have buy ratings on the company and all have fairly recent coverage on the company as well.
Okay. Well, hey, look, I appreciate you taking the time today with us, and we will expect you to be coming back in 2024 to update. And thanks again for the time, Amir.
My pleasure. Have a good one.